Hi, Greg Dorsey here. It's Tuesday, February 2nd at the Leeb Group. Well, stocks rallied again today, but don't get too excited and don't assume the selling is over. One of the best technical indicators that I like to look at to gauge long-term overbought and oversold conditions is what's known as the Koppak Guide, developed by Edwin Koppak way back in the early 1960s. It has proven to be a very useful tool over the years. And right now, it's telling us that the market, and by that I mean the broad market, is about as overbought as it's ever been, even with the selling or buying in the last couple of days. For the market, when I talk about the broad market, I'm talking about the unweighted average of all stocks on the New York Stock Exchange. This treats each stock equally, unlike the S&P, which weights the larger stocks more, and unlike the Dow, which is a price-weighted index, so the higher-priced stocks have a bigger impact than the lower-priced ones. In this case, for the unweighted NYSE average, each stock is the same. A small cap is the same as one of the larger ones out there. Anyway, this indicator has not been this overbought since May of 1983. And I thought I'd look at then and now and just see how the two compare. Back then, we were, like today, about what was believed to be 6 months out of recession. Whether we're out of recession today is debatable, but that is the consensus that we bottomed back in July or so. Back then in May '83, you had valuations were much lower than they are today. On the S&P Industrials, they were trading a little more than a PE of a little more than 12. The yield was almost 4%. Today, the industrials, and I use the industrials because the S&P 500, which includes the financials, is just off the charts with a PE of 86 or so. But the industrials have a PE still very high in the mid-30s. And the yield, the dividend yield, is down around 2%. Actually less than 2% at this point with the trade in the last few days. Back then you had strong growth, as I said, and it was heading towards stronger growth. Well, we have that, but it's debatable whether that growth is going to continue absent government spending. Back then you had real inflation-adjusted yields were much higher than they were today. On long-term treasuries, it was about 6.5%. Today, you're at about 1.7, 1.8%. Back then, inflation was 4% and falling. Today, inflation is 2.7% and rising. And then finally, looking at potential buying power. Back then, you had mutual fund cash positions of 9.9%. Today, 3.6%. Now, back in '83, when we reached a similar level as today on this Koppak Guide, stocks continue to rally for a bit, not significantly, up 4 to 6% depending on the average of years, before falling. And the correction they had was relatively mild. So what this shows is doesn't mean that stocks can't go up more from where they are today, but we wouldn't get too excited about it, especially with valuations as high as they are. And it does point out the risk that things could come crashing down if growth doesn't come on strongly. And growth is really high growth is what's priced in stocks today. If we don't get that, well, stocks will likely have a difficult time of it here the rest of 2010. Wow, it's a long-winded speech today. Thanks for stopping by, and we'll see you again soon.